I'm seeing a few people logging in, and I know there's been some technical issues with everyone getting in. So we're going to just record this call. And if you missed any part of it, we can always come back later. And we'll also be available for some question and answers at the end here. So couple quick housekeeping. If you have any questions, on the bottom, there's a Q&A button. Just throughout the session, feel free to click that and type in any questions, and I'll read those at the end, and Andy and I can answer those. If you need to leave early, I am recording this conference, so it'll be posted on my website, hopefully in the next week or so, and we'll get that up right away. And as always, I know Andy's with OneAscent, but my intention here is for education first and foremost. He has a really unique way of looking at international markets, so I thought that would be something you would all value. So let me tell you a little bit about Andy Manton, our speaker today. So I've known Andy, I think about 5 years now, might be 4. And and I've used him with his previous employer with Shelton International, which quite a few of you were probably involved in with that investment strategy. And we pulled out of that last year, mainly because he left his previous firm, and we didn't know what was going to happen after that. So I'm excited to see that he now has an ETF, which is fantastic. You all know I like to save money, so ETFs just inherently have less fees than mutual funds. So love that we could have that same strategy with some lower fees. But Andy, he's the chief equity strategist and senior portfolio manager at OneAscent Investments. He manages their domestic large cap core. He also is in charge of their international and emerging market equity strategies, and he's responsible for developing and bringing to market new products that deliver OneAscent's commitment to values-based investing. He has over 20 years experience. I mentioned he's been with Shelton International. He used to manage those funds, the international side and the emerging market side. He was also with Victory Capital, Douche Asset Management, and Merrill Lynch. And he's been starting to go out and be on outlets such as Faith Driven Investors podcasts and Advisors Perspectives. He has his MBA from Temper School of Business at Carnegie Mellon University and his Bachelor of Science from the University of Illinois in Chicago. His wife, Karen, and him are members of Fellowship Church in Frisco, Texas, and they are very active members in a ministry called We Want More out in Bridgeport, Connecticut. So Andy, thank you for joining us and being here with us today. And I'm just going to let you take over from here and just enlighten us with some of your thoughts.
Yeah, thanks, Susie. That was a great intro. I don't have to do anything. I was planning on doing that a lot myself, but just a couple of details to fill in there, just by way of geography, location, and where I've been. I'm from Chicago originally, and so I'm a Midwestern guy. But I spent many years in the New York area, and about a year and a half ago, my wife and I were able to kind of escape and get out down to Dallas, Texas, where we live right now with our 2 kids. So we travel around a lot and do have experience in different locations. I started my career in the 90s during the tech bubble. So I've seen quite a few market cycles now, both in the U.S. and abroad. But my main experience, as Suzu explained, is mainly in international investing, equity investing, and that's what I've been doing for the last 15 or so years. So, real quick, I'm gonna do like a brief review of kind of who we are as OneAscent Investments. There's different parts to OneAscent, and I work in the investment side. As I said, I'm in Dallas, but OneAscent is based in Birmingham, and so my team is kind of scattered throughout the area, both in Dallas and in Birmingham, Alabama. Tom Muth, who is our sales on our sales team, who I think might be in the call later. He lives in St. Louis, but those are the 2 main locations that we're all in. So OneAscent Investments, who we are. In a nutshell, we are a values-based investment firm. And I'll explain what that means in a second, but we're a young firm. It started in 2017. On the investment side, we have 11 investment professionals now and just under a billion in AUM. And that's across 55 different strategies that we manage. Anything from models, direct model exposure to individual strategies such as what I manage, ETFs and SMAs. On the investment side, what does values-based investing mean? To us, it's really looking at every company and kind of looking through how each company affects its community. So it's who they affect and how they affect both people and places. That's really important to us, and we just want to make sure that companies are doing things that we agree on and approve of, if you will. The first question I ask when I look at a company really across the world is, what's the product or service that that company produces, and is that a net positive to society or not? And that really helps me kind of, as simple as that is, it really helps me kind of dig into the issues and help me determine if that's a company I really want to get behind and think about investing in. But once we get past that and think that a company might kind of sort of pass our values-based screening criteria, I do a lot of individual fundamental investing, fundamental analysis. It's part of the evaluate part of the process. And then ultimately, we try to put together portfolios that elevates companies or investing in those companies that we want to get behind. And really what that means on the elevate side is different themes, but we want to make sure these companies are again, making the world a better place through different things. It could be just impacting the families that they touch, either with their products and services or just in the communities that they're in. And then I look at various different things as far as company policies in terms of their labor, how they treat their employees, but then how they select suppliers that they work with. So that's kind of how we view the world. It kind of dictates how and really where we want to invest. Today, though, we're here to talk about investing outside the US, which I believe is probably on your minds. I've been talking about this as an international investor for the last couple of years because I think a lot of people have some of the same questions and concerns coming out of a decade that we just saw, primarily where the US really outperformed the rest of the world. And it's really easy to kind of get in this mindset that the US is just always, outperforming the rest of the world. So I kind of started this presentation, if you will, a couple of years ago, and I've given it to institutional investors all the way down to individual investors like yourselves. I can give this presentation with a lot of detail. I could go over an hour, or I can give an abbreviated version. I thought today we'd go with that abbreviated version. So I want to make this kind of short and sweet, but I'm going to throw a lot of information and data at you just to kind of prove these points. So if you have any questions about any of these points, just make a note of the slide number. There'll be a number on the slide as we go, and we can always come back to that slide and take your question at the end. So with that, I'm just going to jump in here. And really, I'm going to dig into what I call 4 myths that I see from investors when talking about or dealing with investing outside the US. And the first 3, I'd say, are going to go pretty quick. It's the 4th one I'm going to spend a little bit more time on. And it's going to be a little bit of a data overload, but hang with me. We'll wrap it all up and make some sense out of it at the end. But myth number 1, let's just get started here. The US stocks always outperform international stocks. So again, this is a kind of a theme and a question or an argument that I get from investors all the time. It's just that belief that, looking back over the years, people can really remember the shorter term. It does seem like US stocks are a much better place to be, and they have been, quite frankly. But there's a lot of ways I can point to this being not true, but I'm going to skip a couple of these slides here and just get to the point because I don't want to belabor it. But the point is that argument is just simply not true. So there's a couple of charts here. The top one is basically just looking at international markets versus the US and how the international markets have outperformed or underperformed the US market over time. And so this is the last 50 years. The lines going up are international outperforming, the lines going down are international underperforming. And when you add it all up, it turns out that 26 of the last 50 years, international markets have actually outperformed US markets. So about half, roughly. So when you break it down again by decade, it turns out that international stocks have outperformed the US in 3 of the last 5 decades, including this last decade that we just had. So again, this belief that US stocks always outperforms is just not true. And if you have more questions or want more proof of that, we can come back to this because there's other slides that prove this. But that is kind of the short, quick point to this one. All right, myth number 2: the best businesses and CEOs in the world are in the US. Now, this is sort of this is kind of a part of our superiority complex that we have here in the US, I'd say, and just the belief that all the best businesses and companies come here to start their businesses, and this is where they really flourish. And that's true, a lot of them do, but not all of them. There's a lot of companies that we just don't hear about outside the US. And there's one way that I like to kind of poke holes in this myth. And it's with a survey that Harvard Business Review used to do. They stopped doing this in 2019, as it turns out. But it's a survey that was, or not a survey, it was a study that they used to do. And it was a purely quantitative study. It wasn't subjective, it was quantitative. But what they tried to do is they looked at every company in the world, and they looked at companies that had a CEO in place for at least 3 years. And then they just measured the stock performance of those companies from the date that the CEO came into office to the day that they cut this off, which was the end of 2019. And that was supposed to be a measure of the shareholder value that CEO created over their time frame. And I thought it was a really good way to kind of pinpoint good managers throughout the world, and also good companies. So, and the results to me as an investor are fascinating. Again, there's 100 CEOs or companies that they list, and there's lots of things to point out. Here in the right, I've got the top 10, and the things I want to point out here is that 4 of them are international companies. So that leaves 6 that are US companies. But of the 6, all 6 of them are in the technology sector. Even MasterCard is a tech company, arguably. But these companies really got a boost over the last decade, maybe not just from sheer brilliance of the management team, but maybe because of other trends I'm going to talk about in a second that helped those stock prices go up. But if you look at the international names here, there's some great diversity. These 2 companies, Kering and LVMH, are actually luxury brand companies. This one here, KBC, is a bank. This one is a utility company, a Spanish utility company. So very different industries with CEOs that produce value in the same league as some of these other great US companies. That says a lot to me. Especially, just given this as a utility company, it's fascinating. But when you take a look at the rest of the list, of the top 20, only 9 are in the US, so over half are international companies, international CEOs that have produced really good value for their shareholders. And when you look at those 9 that are US companies, 6 of them are tech companies, where the growth in the business model likely mattered more than the manager, I'd say. So that's kind of the point that I use to poke holes in that myth that all the best CEOs, management teams, management talent are in the US only. I think that's just simply not true. And by the way, Harvard Business Review stopped doing this list because they felt that there was too many white males on the list. So they decided to stop producing this list, unfortunately. So we won't see this again, but the link is down here if you really want to see this last one they did. All right. Myth number 3, the European economy is lagging, so there's no need to invest there. So I get this a lot. I'm going to pick on Europe for a second because people like to pick on Europe, I guess, but there's other markets and regions that we can talk about as well. But I'm just using Europe as an example here. So bear with me. But this is really an argument that people use a lot to say, look, the U.S. economy is fine. It's great. It's superior to everybody or everywhere else. So I don't need to even look at companies outside the U.S. and other markets. So I'm going to tell you why that's just why that shouldn't be the case either. And the simple point to that is if you look at European companies, for instance, and this is the top 100 European companies by market cap. Okay, so it's kind of missing a lot of the more mid-cap names that are smaller and maybe a little bit more agile. But when you look at the top 100 European names, this chart here is just looking at their sales exposure, the revenue exposure to the European economy. And where it averages out is right around 40%. So what this is saying is that on average, a European company has just 40% sales exposure to the European economy. So what is it? Why do we care? What does that really mean? Well, there's plenty of U.S. companies that have 40% or, exposure to the European economy as well. But the point is that they're selling other things, the other 60%, to other parts of the world. It could be Asia, it could be the U.S., wherever. But just because they're based in Europe doesn't mean that their fate lies with the economic success of the European economy. So that's kind of the main way I want to try to change people's mindset of looking at companies based outside the U.S. That just because they're based in a company or a country or region that might be a little slower growing or otherwise challenged at the moment doesn't mean that we shouldn't look at the companies that are based there. So. All right, so last myth, which is going to take a little longer here, but there's this myth that the U.S. market has been the strongest because it's been the healthiest. Again, so we look over the last 10 years and the stock market has soared. People think the economy is great. Certainly, if you listen to the politicians, they'll agree with you there. Everybody wants to take credit for the so-called strong economy. But there's a lot of things that I want to point out that simply drove that and drove that to be true for the last 10 years, but it is going to change, I think, going forward. And the first thing I want to really point out here is that, everybody knows that interest rates went down over the last decade, right? This chart or this table right here is looking at 10-year government bond yields at the end of 2009 and at the end of 2019. And you see how the U.S., for instance, went from almost 4% down to under 2%. And we all know that they went a lot lower during the pandemic. Europe, however, went from similar levels as the U.S. at the start of the decade and then went down to sub-zero levels just prior to the pandemic. Japan has always been low, and they went down to sub-zero as well, and they've been sub-zero for probably the longest. But what does that mean? So what does that mean is that investors in Europe and other parts of the world don't necessarily want to invest at least their fixed income money in bonds in Europe, because that sounds, negative 19% or negative 19 basis points sounds like a really terrible yield to me. I wouldn't want to invest there either. So they're looking for yield. They went looking for yield, I should say. And how did that manifest into numbers? Well, if we look at the European Union and how much money they had invested in U.S. treasuries, just U.S. treasuries, over the 5 years so the second half of that decade, the number or the amount of U.S. treasuries that the EU owned went up almost 40%. That's a lot. $400 billion worth of new demand for treasuries right there. Europe is by far the biggest holder of our U.S. Treasuries, and that kind of debunks another myth that China owns all our debt, and we're beholden to them to make sure they don't sell all that. That number has been going down actually over the years, and they're slowly selling that down. That'll continue to go down. Japan just has less money to spend. They're just buying less bonds outside of Japan. But Japan owns more than China, and they both own a lot less than Europe, just as another point there. Okay, so to further illustrate that point, I'm going to take an example and deal with the Norwegian Sovereign Wealth Fund, which is the biggest sovereign wealth fund in the world. They're really good about transparency, and they publish all of their holdings, which I look at every year just to see what they're doing. But here's the trends that I've noticed. Over the years, so from 2007 to the end of 2019, the equity exposure in the Sovereign Wealth Fund has gone from under 50% to just over 70%. So that's a huge increase. It might not seem like a whole lot, but that's a huge increase. And what that's saying is they went to basically a 70-30 split, where 70% in equity, 30% in everything else, including bonds, private equity, alternatives, whatever. That drove a ton of demand into stocks. So that's one big boon for US stocks, certainly. But how much of a boon? Well, the percentage of that equity, which is in the green line here, as you can see, is they had it under 28% of their equity was US equity in 2007, and that went all the way up to 46% of the equity, overall equity in US equity. So US equity got a double boon here, a double benefit here, if you will. Just the overall increase into equity, but the overall increase into US equity as well. And that is symbolic, but also I think a good illustration of just what happened across Europe and other regions as well with institutional investors, and just the foreign demand that flooded the US market as well. And the blue market, or the blue line down here, by the way, is the percentage of their fixed income allocation to US fixed income bonds. And they went from 32% to roughly 40%. So a bit of an increase there, even though fixed income as a percentage went down, they're still looking for more US bonds. So that's sort of fascinating. And I just wanted to point out that's been one kind of tailwind for the US market. Just a flood of money coming from overseas, which is why the US dollar did very well as well the last decade. All right. Something we've sort of forgotten about, the 2017 corporate tax cuts that Trump put into place. It was great, great for everybody. We needed it. It certainly made our corporations very competitive. But what it really did, though, is it really helped to buffer a trend that had been set in place as early as 2014. And it sort of masked this, but here's how I want to explain this. So 2014, U.S. corporation profits before tax. So this is the profits companies have before they are taxed. Started going down from 2014, and it's been going down since the end of 2019. Profits, though, if I was to put that chart up here, have been going up through here, and that's because the corporate tax cut really helped that. Now, it's been great for earnings. It looks good. Everybody loves that. And I'll tell you where those profits went in a second. But the problem is so that's been a really big tailwind for stocks. But that's ending. As we all know, there's the corporate tax rate is going to go up. And there's all kinds of other taxes that the government is looking to place on corporations in the U.S. now, and so there'll be a bigger tax hit. So instead of that being a tailwind, it's going to be a headwind going forward again. All right. So where did that money go? Well, a big chunk of it went into buybacks. The reason I bring all this up, because again, hang with me, I've got a big point at the end, but over this decade, from 2009 to 2018, the S&P companies in the S&P 500 spent $4 trillion on buybacks. That's 52% of their net income. That is by far the biggest demand for buying U.S. companies out of any source over that period, by far. In 2018 alone, the year following the tax cuts, companies bought back just over $800 billion worth of stock, which was roughly 70% of net income. So they took that benefit they got, that extra profits, and they just bought back more stock. And this is exactly the fear that politicians were talking about before the tax cut went into effect. Certainly what the left was arguing for is that there was going to be no trickle down. It wasn't going to go into R&D. And it didn't. This kind of proves that it didn't. In fact, only 43% of companies reported any R&D in 2018, and 38 companies accounted for 75% of all R&D in the U.S., which is sort of stunning in that year. One point that I want to just touch on, we could talk a lot about this, is that the reason this is sort of a U.S. phenomenon, and it's not really a big deal across the world, is that CEOs they've really changed the way that they get compensated. A lot of their compensation, if you talk to CEOs, is based on earnings per share now, or earnings per share growth, earnings per share targets. A really good way to massage that number is with corporate buybacks. And that's kind of what's going on, which is, again, very short term and not a really good way to view stewarding their company overall, I'd say. So it helps shareholders in the short term, but it's not utilizing capital in probably the best way if they really stop to really focus on that a little bit harder. Anyway, I can go into that. It's probably a whole nother webinar, but I wanted to touch on that. The other point of this is that 30% of these buybacks in recent years were done with debt. So not only were they using profits to buy back stock, they're issuing a lot of debt to do so, and they're kind of leveraging the company with the low interest rates, which sounds like a great deal, to buy back stock that is a higher cost. Yeah, I see where they're going with this. It's something to just pay attention to, because obviously interest rates have gone up. If they don't pay back the debt, they're going to have to roll it over at much higher interest rates. So there's an interest rate or rollover risk to that inside of a lot of companies. So a lot of the ones that don't have strong cash flows are going to be hurting in the next 3 or 4 years, I'd say. So something to keep remembering as we go forward. So speaking of debt, what those low interest rates that we saw did over the last 10 years is just encourage the use of more debt. This chart here is pointing out two things: just the sheer corporate debt value in absolute terms, and this orange line here is the corporate debt in the U.S. as a percentage of GDP. These lines here are pointing out the peaks, and it's interesting because the peaks seem to happen right before we go into a bad time. So this is right before the tech bubble, and then it went down a lot. This is right before the financial crisis, and then it went down a lot. In 2019, you see that it was above that level, and actually, if I was to extend this to today, it's actually gone higher. So corporate debt as a percentage of debt is going up. Now, some people would argue, but that's because interest rates are more manageable. That was true a year ago, 2 years ago. That's not true anymore. Interest rates are up, they're higher, and they're going to be higher for longer, I believe. So that corporate debt looks pretty risky as well. So that is one thing to keep an eye on. Again, this use of corporate debt was a tailwind. It is now going to be a headwind, or certainly not going to provide the boost that it once did for corporations leveraging themselves. So next point, the Fed. So again, I probably should have started with this one, or could have started with this one. But I just want to make this point, which I'm sure you probably all heard before, but the Fed has been kind of bankrolling this last 10 years of stock gains and market gains. Here's the Fed's balance sheet. This is 2008, right before the crash. We all know that the Fed came in and did what we call quantitative easing. They started buying back a lot of debt, lots of different debt, corporate bonds, treasuries, mortgage bonds, things like that. But what we sometimes forget is they never stopped that. In fact, they just kind of hit the accelerator around 2010, and that just kept going up and up and up. Interest rates kept going down, falling. Then when we needed the Fed to kick in, they did. And this is just after the pandemic, after they went into emergency mode again. That number is kind of peaked out here and is now going down. Okay, so what does that mean? So it means that's a lot of liquidity the Fed has provided. It's 3 times the level of liquidity that the Fed had on than they did prior to the financial crisis back here in 08. The Fed has realized they can't just keep doing that. In fact, they're going to have to reverse that. And that's going to create a lot of dislocation in the fixed income market, which could spill over into different markets. Not to scare anybody, but this is something that it has to come to an end, and the Fed knows that. The stock market does not realize that, though. They seem to believe, market participants seem to believe that the Fed is always going to come to the rescue whenever there's a problem and just kick in quantitative easing, inject liquidity, and we're going to be okay. Interest rates go down, stock market goes up, we're going to be okay. The Fed has been saying, we're not going to do that now. We're not going to keep doing that. And the stock market just does not want to believe them. But it has to. It has to happen. So this is another kind of thing to watch, apart from interest rates just being held higher for longer, as the Fed's saying they're going to do. They're also doing what's called quantitative tightening, where this is going to start reversing. And that's going to have a secondary effect on everything. So just something to be aware of and to watch out for. And then the last point here is what I would describe as the value disconnect. So this colorful chart here is comparing the US market's PE ratio, or forward PE ratio, I should say, to the forward PE ratio for the rest of the world. So white is the US market forward PE, green, rest of the world market forward PE. This down here is the difference. So it's just taking the US market forward PE minus the rest of the world. Okay, so we get a spread. So we can see what the difference is over time. And this is what I want you to pay attention to, this one down here. And you can see right before the financial crisis, there wasn't much difference at all between the two. They were trading at virtually the same forward PE, so virtually the same valuation. Once we hit QE, right in here, interest rates started going down, and we began this incredible rise in this gap, which doesn't look like all that impressive, but it's significant. It's huge, actually. And it's been driven by all the different points I just talked about. All those tailwinds that the US market had. That's what drove this disconnect here. And yes, last year it peaked out and then went down, but we're still, this goes all the way to as of yesterday, we're still at levels that we were at just prior to the pandemic, which was still high, which was still a peak, I would say. So we're just back down to those levels right now. So with all the different things that I think are coming against the market going forward, we might see this start to shrink a lot and go back down. So if that's the case, a better place to be would be international or non-US stocks, equity, to take advantage of that gap change or gap shrinkage. So that is kind of the last point I wanted to make. And just to summarize real quickly here, I'm going to read these fast, and then we'll get going into something else. But again, the points are: U.S. market has outperformed international stocks over the last decade. True, yes. But when you look further out, international markets have outperformed 3 of the last 5 decades. Okay, that's point number 1. Point number 2, some of the best management teams and CEOs are at companies outside the U.S., while the ones in the U.S. are seemingly or were seemingly concentrated at tech companies. Again, because of some of the issues I've talked about. Point number 3, the economic health of a country or region doesn't necessarily determine the health of the companies domiciled there. That's just a change in mentality of when you look at companies that are outside the U.S. in a certain country. And then finally, when you look under the hood, the U.S. market is being held together, or was being held together, by several factors that may be temporary or may be changing, I should say. Low interest rates drove foreign demand for U.S. assets. Will this continue now that U.S. interest rates are increasing? Tax cuts helped to shield falling pre-tax profits. A reversal of these cuts would be devastating, which is already happening. Share buybacks have been an incredible market force, but are now being studied closely. And by the way, I don't know if I mentioned it, but share buybacks are being taxed as of right now. And they're looking at making those taxes even higher. So the ability of companies to do corporate buybacks, share buybacks, is lessening. It's going down. Certainly the appeal of it. So the Fed's backed into an inflation quarter now. They after a decade of unprecedented stimulus, they can't just reverse course anytime soon. And all this combined has led to peak multiples not seen since the tech bubble, even after the partial unwinding of the growth stock bubble of the last year or so. So that is really it. That's kind of the Y International summary or rebuttal to some of the myths that I hear in the market. And we can come back to any of this, but I just want to mention that I hope I didn't scare anybody into or out of investing altogether. But there are alternatives to the U.S. market. I do run a U.S. fund as well, so I'm not just biased against the U.S. I do have plenty of my own money in the U.S. ETF that I manage as well. But there's 2 other alternatives that I manage. One is the OneAscent International Equity ETF. The ticker there is in yellow, OAIM. This is just some quick points about it. And the other international fund that I manage is just a pure EM ETF, OAEM. You can plug those tickers into Morningstar to get more information. But the thing I want to point out here is that the number of holdings that we have in each fund is relatively small. I run concentrated portfolios. I like to be all in on the companies that I do select to invest in and choose to elevate, if you will. So we'll have anywhere from 30 to 40 names in each of these funds at any one point in time. So real quickly about how I run the portfolio. As Suzu said, it is a little bit different, my process, which I won't really go into now because I don't think we have much time here. But what I'll just say is that it's a pretty significant process. It goes through a lot of different steps. So basically, it goes from anywhere from idea generation, which is a quantitative screen that I have that helps me select companies to actually go ahead and look at. And I look at companies based on where they are in their corporate life cycle, which I can go more into later if anybody has questions about that. But I do a lot of work with valuation. We've got a proprietary discounted cash flow model that we use here to look at the sensitivities and valuation for every company we look at. And that goes with the broad fundamental analysis work that we do. And we look at a number of different things for every company we consider. But that gets thrown into the portfolio construction phase, where I'm selecting companies out of the buy list that we put together. And then we put together these concentrated portfolios for you. So the output of all this is some really great companies. I've got here a list of a lot of different companies and what they do and how they actually add value to the world. I won't go through them, but if you'd like to see them, I'd be glad to send these out to you all, or to Suzu, who can send these out to you. But it's just examples of how these companies, what they're doing, and how they're helping society. And there's some amazing companies out there. So I'm going to end it there. And Suzu, I'll pass it back to you. Was there any questions that you had that people had written in, or any that you had?
Well, I have a question, and just as a reminder, if anybody does have questions for Andy, go ahead and click that Q&A button on the bottom and type that up, and I'll be happy to read those to him. But one was just a confirmation. You had mentioned our corporate tax rate in the U.S. is changing. Can you remind me, what year is that? My brain is telling me 2025. Is that when those reset back up to those 35 ranges?
It's a great question. I'm unsure.
Okay.
Yeah.
I will confirm that back if anybody else cares about that as much as I do. And then on slide 24, you had talked about all the different debts and the pricing and the flooding and within our own federal government. And just curious, how do other countries compare to that? Because I know we weren't the only ones releasing a bunch of money and tightening money and raising interest rates. Quite a few other countries are following suit with that. How do they compare, looking at the big scheme of that compared to the US?
Yeah, well, so I guess the closest example is definitely Europe. So Japan has always had a bloated balance sheet. So the central bank has. The central bank owns a disproportionate amount of assets, including fixed income and stock in Japan. That's kind of a separate issue. It's very different from the US, but it is bloated for sure. But it's been that way for over a decade.
Okay.
So if you look at Europe, their central bank balance sheet, it looks the same. It's just smaller, in overall absolute terms. But so they're going to have the same issue though. They're going to kind of have to go the same route as us. So they're going to pull in liquidity just like us. Okay. So, and that's true for a lot of different smaller companies around the world. Okay. I mean, everybody was doing some kind of quantitative easing through the pandemic, and that will be reined in around the world. Yeah, and by the way, that's this is why there's so much inflation right now.
Yeah, absolutely. And then, if you don't mind, I know you had a few different companies. Do you mind just maybe sharing one of them? And why did you pick that one? And what's attractive to it? Being one of the portfolios you manage. So you don't have to do all of them, but like your favorite one.
Yeah. So
and let me add too, just so you all know, just because he's talking about it doesn't mean go buy that stock outright. He's not doing this as a recommendation. He's just talking about it within his portfolio, why he picked it. Okay.
Thank you for that. Yeah. I should have caveat that as myself. But I'm just looking here. All of these companies I've invested in probably about a decade or so or longer. So they've been in my portfolio for a long time. But so these are not like new buys that I'm trying to talk about. But I'll talk about Bank Rakyat. So Indonesia is a relatively poor country. The poverty rate there is pretty high. It's about 50%, and but that's up, or that's down quite a bit. 10 years ago, that was at about 80%. So almost, so over 2/3 of the country was living in poverty, which is pretty amazing. They have Indonesia. A lot of people don't realize this, but it's the fourth most populous country in the world. Tons of people living in a very challenged environment because it's an archipelago with a lot of different islands that are not easy to get around to. It's an interesting country, but fascinating and fast growing and entrepreneurial. It's amazing. So because of this issue, what the government's done is, I think people have most people have heard of micro lending, and that term, that industry kind of sparks either really good or really bad visions in people's minds. There's a lot of predatory lending that goes on throughout the world via micro lending. But the government of Indonesia has really figured this thing out, I think, and they have put together a program. Now it's over a decade old now, but it's a nationally run micro lending program that they let the banks administer and go out and activate. So the rules are the government puts the rules in place. The banks are the ones that actually put this thing into motion, and the ones that are able to really benefit from it for doing so if they do it correctly. So it's a great story of public-private partnership that has worked very well. So the benefits again are pretty remarkable. There are over, and I have some incredible stats on this, but there are millions of people that have benefited from these programs. It has really lifted. It's not the only reason that the poverty rate has come down so much, but it's one of them. And Bank Rakyat just happens to be the biggest provider of these loans. So it's a really good deal. The interest rates are capped. The lending goes on by people walking around with a cell phone as a loan officer. Basically, there's not many branches. They just go out with a cell phone and they're able to approve people for these loans throughout the country in very unbankable areas of the country. And it's an incredible story. Unfortunately, I don't have all the stats on this slide, but they're pretty amazing. Just how many people they've touched and the families that have been lifted out of poverty because of this.
That's a great story. So it's basically we as investors can help support that bank.
Yeah.
And then we're making an impact on everybody's lives that they're serving.
Absolutely.
I know I've heard stories. I don't know this one in particular, but small banks doing the micro lending and just getting a sewing machine into a single mom's hands where she can now sew clothing and now she can feed her family and eventually grow that to help other moms out. So it's a huge impact that we can do as investors.
Indeed.
And have a win-win situation for everyone to be profitable.
Yeah. And it's a good story of scale too, because when I first started investing in this company, it was probably about 15 billion in market cap, and it's 46 billion now. So it's up 4 times. Just an amazing story, and it's been a great investment for our investors. So it's a win-win, but these are exactly the type of companies that we want to get involved with.
Great. Well, thank you.
Yeah.
Well, I'm not seeing any more questions. Anything else you want to add, Andy, or?
No, again, I just, I hope that didn't come across as just being cynical and against the US markets. I just wanted to point out a lot of things that we don't really talk about. You won't hear in CNBC or any other places, but we as investors really look at a lot of this stuff, and it really matters to us. And I think part of the reason I wanted to come to OneAscent is to work closer to you and to your clients, because it matters. We need to know these things, and I think we need to be invested with people that managers that are doing right by society and producing value. So
Well, thank you very much. I know I've enjoyed watching OneAscent. They're just so innovative with how they're trying to help people invest and just going outside the box thinking, which is really where I think a lot of the profits are going to be as an investor to be able to do. We can't just do it the old school way any longer. Times are changing. So I like how OneAscent is enabling you and your other investment team to be able to do that. It's a great opportunity. So
for sure. I think the message real quick is that when I came to OneAscent, what I really wanted to get across to people is that we can invest this way and not sacrifice returns. I mean, you're welcome. I welcome everybody to go to Morningstar and look at our funds. And we're, the EM fund right now is ranked year to date in the top 1 percentile of all EM funds, not just ESG or values-based funds. I want to be the best emerging markets fund out there, the best international fund out there. And we can do that. We don't have to sacrifice return just because we're investing in companies that are quote unquote special or different.
Yep. Well, no, I know I'm glad that you're back and I have somewhere to park the international side again. So
Yeah,
thank you for that. Thank you for your time and for just educating us all and sharing some of your
absolutely.
wisdom. I really
My pleasure.
appreciate it. Thanks.
Absolutely.
Have a wonderful day. Bye.